Welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty decline after hitting record highs in early trade. Nifty manages to stay above 22,000. Mid-caps and small caps see sharper cuts. Mixed bag for HDFC Bank in Q3. Net profit beats estimates. Net interest income misses street.
The instability, that includes things like US-China relations, that could slow down all this progress. And so hopefully you get reasonable works on both sides. And, India can play a role there.
Bill Gates says India can play a role in diffusing the tension between USA and China, adds that the Delhi G20 did was very constructive as it turned the attention to a win-win situation. That's an exclusive. SBI Chairman Dinesh Khara says RBI has been tightening unsecured loan norms as it wants to avoid overheating of the system. Axis Bank CEO Amitabh Chaudhary says the new norms are likely to temper credit growth. The Reserve Bank of India looks to tighten deposit-taking norms for housing finance companies in a bid to bring them at par with the NBFCs. The central bank releases a draft circular proposing that HFCs maintain 15% of public deposits in liquid assets versus 13% currently. 2 weeks for the interim budget. Sources say that the government is considering extending the 15% concessional corporate tax rate for new manufacturing companies. Discussions currently underway on up to a 2-year extension. The Supreme Court upholds Delhi High Court's order referring the 150 crore rupee dispute between SL Group-owned City Networks and Aditya Birla Finance to arbitration. Cites its recent judgment where even non-signatories to an arbitration agreement can be subject to IT under the group of companies doctrine. Aditya Birla Finance claims City defaulted on the loan extended to it, claims that Z agreed to be the guarantor. Fears of a wider war in the Middle East grows after Iran strikes targets in Syria and Iraq. US terms Iran's attack reckless. Israel continues to pound Gaza. Hamas claims more than 24,000 Palestinians have been killed so far. Yemen's Houthi rebels strike a US cargo ship in the Red Sea and threaten more attacks. Crude oil prices inch higher amid escalating tensions. The US and UK want further action against the Houthi rebels. The Civil Aviation Ministry sends show-cause notices to IndiGo and Mumbai Airport after a video went viral showing passengers sitting on the tarmac eating food. Both the airline and the airport have to respond to the ministry by the end of day. IndiGo says it has already initiated internal inquiry. And Donald Trump wins the first Republican contest ahead of the 2024 U.S. presidential elections, wins the Iowa caucus with 51% of the votes. Vivek Ramaswamy drops out of the Republican presidential race and endorses Trump. All right, let's get started with the news just coming in. HDFC Bank has reported a mixed bag in the third quarter. Abhishek Kothari is here with the numbers. Abhishek, over to you.
Well, it looks like a mixed set of numbers coming in from HDFC Bank. They only had 1.9% sequential growth in deposits and their interest expense is up 4.5% quarter-on-quarter, and it looks like this might have hurt their net interest margin. Net interest margin was likely to remain stable at 3.4% as per Nomura estimate. However, the NII growth on a sequential basis is lower than that of the loan growth, which means that there might have been compression in the net interest margin. The NII at 28,471 crore is 2% below our poll of above 29,000 crore. So net interest margin might have hurt on the top line. Other income has remained stable. Operating profit growth is of 4.2% quarter-on-quarter. However, despite the fact that asset quality has improved, provisions are up more than 45% quarter-on-quarter, suggesting that credit costs might have spiked up, and this provisions has actually impacted the PBT. So PBT, profit before tax, has seen a decline of 1.8%. Now, tax outgo was supposed to be on the higher side. However, it's worked on the reversal, and so tax rate in this quarter is 15.7% versus 19.3% 3%, and that lower tax has actually aided the profit to be higher than our poll. Our profit has come in at 16,373 crore. We're working with a number of 15,600, 15,700 crore. So lower tax outgo has actually aided the profitability. In terms of asset quality, gross NPA and net NPA in absolute value is down 1.8% quarter on quarter and more than 5% sequentially in terms of net NPA. So gross NPA ratio and net NPA ratio both have improved sequentially, and PCR has also improved. That is provision coverage ratio, that's also improved. So asset quality, no hiccups seen. However, the spike in provision and lower net interest margin could actually weigh on the stock price tomorrow. Back to you.
All right, Abhishek, we are also joined by market expert Prakash Diwan on the broadcast. Abhishek, do you have any questions for the kind of numbers that HDFC Bank has reported for our guest?
Prakash, to begin with, the top line looks to be on the weaker side, especially due to a cost of funds that could have actually weighed on the performance. Your first take on the results?
So, Abhishek, first and foremost, thanks for such a sharp analysis of the numbers and so quickly while the headlines were being read out. You managed to cull out some very interesting changes in how it's behaved, how the numbers, parameters look on a QoQ basis. So let me focus right away on what might trouble the street in these numbers. So while cost of funds was likely to go up, has been up for mostly everybody, we always felt HDFC could get away with a slightly lower hike in fund costs, but that doesn't seem to have happened because you've seen the NIMs compress. Their inability to grow the book with any kind of personal loans, the side of the personal loans, and the way the RBI is clamped down on that segment also tells you that it's going to be difficult to pass on higher cost of funds in your credit growth, right? That's one thing. But on the profitability side, if you look at the lower tax outgo is so what the provisioning, the higher provisioning, the provisioning is almost like, if I get my numbers right, it's almost from 2,900 crores, it's close to 4,000 plus. So there's a 30%, 40% hike. So what the provisioning taketh away, the lower tax rate is giving in this case, right? So that's what's happened is it got balanced out. But the integration that you are seeing on the ground, and then let me go straight away to what is it that the street would look forward to from the call and subsequently, is that this is the second quarter post the integration. And there is one thing that seems to have normalized, and that is there's absolutely no dilution in asset quality, whether it's on the gross NPA or the net NPA. So, which means that you don't anymore have surprises. They had alluded to this. They had managed some expectations, saying the quality could take a bit of a hit, which happened last quarter. But this quarter, things seem to have normalized on that count. Now, if the commentary is positive on credit growth, in which segments they are likely to grow, and if cost of funds can probably peak out, which seems like peaking out given the narratives from other bankers around what they expect the RBI to do and things like that, then you probably might be able to mitigate or live with this lower revenue growth, top line growth, because I don't think anybody has doubts that the margins have been under pressure, will be under pressure for some more time till interest costs remain elevated.
Prakash, just to augur with your point, they have been the only lender who has actually grown their deposit base over the last 1.5 or almost 2 years now. Right from the time that they announced their, merger intention with HDFC Limited, their deposit growth has been north or ahead of the entire street or the sector as well. So it's difficult to gauge that, interest expenses right now hurting them, given the fact that they already have a huge base as well. I'll just come back to you. We also have Rahul Malani from Sharekhan joining us. Rahul, what do you make of the numbers in terms of the first cut that you have?
So, first of all, good evening. Overall, at NII level, it is 5% below our estimates. We were working with marginal improvement in NIMs by around 5 to 6 basis points, resulting from the release of the liquidity from the ICRR impact. But that has not played out, rather than the margins are stable. And that has resulted in the operating profit coming below at 4%. On the provisions level, if we look at the provisions, our core credit cost is stable at 49 basis points. So overall, additional 1,200 crore provisions have been included in contingent provisions. So, and at the PAT level, it has not translated into underperformance because the tax rate is lower. So overall, the margins are below expectations.
Well, Prakash, Rahul mentioned that margins are below expectation. Yes, Nomura was working with a flat net interest margin, 3.4% versus 3.4% in the previous quarter. Would you be concerned about the decline in net interest margin in the current quarter and subsequent pickup in the coming period? Would you give a thumbs up to that, or would you be concerned about the decline in net interest margin?
No, absolutely no. No, there's no concern. In fact, there was an expectation, and it's absolutely on those lines, given the fact that everybody is experiencing a peaking out of interest rates. Now, if the bank were to, let's say, roll out deposits or any kind of a liability side product with lower costs, I'm sure they're going to keep on getting the response. As you said, they have deepened the investor base for their deposits in such a significant way that their presence today in the deposit market and wholesale and retail both is so strong, given the legacy of the HDFC Limited and the franchise of the bank, that I would believe they'll be the first to get any kind of an advantage that percolates to lowering of interest rates. So if that were to happen, and as I said, there has been a product mix shift which doesn't allow a bank which is very conservative, wants to focus on quality, to be able to pass on higher costs to borrowers, right? So you don't want to be doing that if just because your cost of deposits is higher. So I think from that perspective, this is a balancing out quarter, and for subsequent quarters, and I'm sure the commentary will give some sort of a clear direction in those lines, but the subsequent quarter would probably see an improvement in NIM. So if NIMs expand, credit growth expands, quality remains benign, your provisioning is absolutely sharp, there is no reason why the bank wouldn't get re-rated.
Well, thank you, Prakash. As you mentioned, this is a balancing out quarter, so one can take this with a pinch of salt and, look for improvisation in the coming quarters as well. Thank you, Rahul, for joining us. Back to you, Archana.
Thank you, Abhishek, for that, and a big thank you to our guests. On that note, we will slip into a short break. Stay tuned. We'll be back. Welcome back on to a CNBC-TV18 exclusive. The government is considering extending concessional corporate tax rate for new manufacturing firms. Sources tell us that the industry is in favor of the extension and believes that it's pivotal to attract investments. Timsi Jaipriya joins us now with the details. Timsi, what are your sources telling you?
That's right. Sources tell CNBC-TV18 that the government is considering extending concessional corporate tax rate for new manufacturing firms in the upcoming interim budget. Sources say that their discussions are currently underway to give at least 1 to 2 year extension to the sunset clause, which expires on 31st March 2024. However, no final decision has been taken so far, but just for a better understanding for our viewers, 15% corporate tax rate is currently available to new domestic manufacturing companies under Section 115BAB. To avail this, the condition was that the new manufacturing units have to commence manufacturing operations by 31st March 2024. Since this sunset clause is expiring, the proposal on the drawing board is to give this sunset clause an extension. Whether it is warranted or not, it is something that the discussions are still underway, and it is also one of the major asks of the industry. And India Inc. feels that if extended, this will be pivotal in attracting investments, also will help continue to promote the ongoing Make in India drive, and gels well with the idea of making India a manufacturing hub. So let's see whether the proposal makes it as part of the key interim budget announcements or not. Back to you.
Right. Thank you, Timsi, for that update. The Supreme Court has upheld the Delhi High Court's decision to refer the 150 crore rupees between Aditya Birla Finance and City Networks to arbitration. This is a cause of concern for Z, as the company is the guarantor for the term loan that was extended to City Networks by Aditya Birla Finance under a credit arrangement letter in 2017. Ashmit Kumar joins us with the details. Ashmit, how will this impact Zee Entertainment and what does this mean for the company now?
Right, concerns mounting as far as Zee is concerned. Now, keep in mind that the heart of the issue is a loan facility extended by Aditya Birla Finance to City Networks, which is a part of the same network as Zee Entertainment. Now, what's concerning here, as far as Zee is concerned, is that this loan that was extended for $150 million was defaulted upon by City Networks, and then subsequently, Aditya Birla Finance had moved the Delhi High Court claiming that Zee Entertainment was the guarantor and therefore there should be arbitration proceedings where Zee should also be included. Zee's contention, of course, has been that it's not been signatory to this loan facility and therefore should be kept outside the bounds of this arbitration agreement. However, in 2023 March, the Delhi High Court had referred this matter to arbitration, and importantly today, the Supreme Court has upheld that Delhi High Court order referring this dispute to arbitration. In the course of its orders, the Supreme Court cited its December judgment, whereby it held that even non-signatories to an arbitration agreement can be bound by it, provided the arbitrator rules in that favor. So to that end, the window has been kept open. Zee is allowed to raise its concerns before the arbitrator, but importantly, the issue has been referred to arbitration. Zee will be allowed to make its representation, but nonetheless, that companies, the group of companies doctrine is available, which is that even non-signatories can be roped in into arbitration. And number three, of course, is the demand itself, the outstanding dues of 130 crores being claimed by Aditya Birla Finance plus interest.
All right, thank you, Ashmit, for that. With that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.